Good morning, everyone. Welcome to Phillip Securities Research Morning Call. For today, we have stock counter updates, results updates for Keppel DC Reit, Keppel Corp, and Fortress Minerals. And also we have Phillip on the ground for Keppel Reit, Keppel Infrastructure Trust, Mapletree Logistics Trust, Mapletree North Asia Commercial Trust, Aztech Global, and Avarga. Then we'll be wrapping up with Singapore Weekly. So without further ado, let me begin with Fortress Minerals. So I'll be covering the 4Q FY21 results update, which we see continued outperformance from. Referring to the first positive point on your right, and also if you refer to the table on the left, the volume of iron ore concentrate sold increased 66.7% year on year to 149,000 dry metric tons, if you refer to the second line in the table. And revenue also more than doubled year on year, while PATMI almost tripled year on year. So the revenue growth is also attributed to higher prices for high-grade iron ore concentrates, which I'll be explaining more in the next point. So the second point, gross profits more than doubled to $13,000, and we also see an improvement in gross margins, if you refer to the last line in the table, from 67.1% to 78.6%. So this is driven by higher ASPs, which reached a record $120.7 for the quarter, and also lower average unit costs of $20.7. And this is achieved through efficiency gains. So the third positive point, operating cash flow increased from negative $11,000 to a positive $2.7 million. And for the free cash flows, even though it remained negative at $4.2 million, but on a full year basis, it increased 48% to a positive $7.1 million. On the negative side, the capex increased from $390,000 to $3.6 million for the quarter. And this is attributable to the expansion of truck fleet and reinvestment at the Bukit Besi mine for further exploration works. So if you remember, during the initiation that we did on Fortress Minerals and also the third Q update, we also mentioned that for the total concession area at the Bukit Besi mine, only 5% has been explored so far. So for their currently at the Bukit Besi mine, they have the East and West Valley deposits, and for the further exploration works, they are digging around the East and West Valley. So that has contributed to higher capex. Moving on to the outlook, we still expect iron ore prices to remain above $110 per dry metric ton in 2021. And according to the benchmark of the Platts IODEX, current prices are at about 180. This is mainly due to the fact that according to the World Steel Association for 2021, they forecast that the global steel demand will grow by 5.8%. And also for the first 3 months of 2021, the steel production for the whole world has already grown by 10% to 486.9 million tons. For Fortress Minerals, we are still projecting an increase in revenue due to the expected increase in iron ore production at 10% for FY22. And for the offtake agreement, it would last until end of first half of FY 2022, which is August 2021 this year. But the management also shared that they are in talks for discussion for new offtake agreements. So we raised our target price from 47 cents to 64 cents as we roll over our 11 times PE target to FY22E, which is still in line with the industry average. So the FY22 PATMI has been raised by 27% to $21.8 million as we forecast higher production volume from sustained growth in demand from Malaysian steel mills, which is their main customers, and also for iron ore prices to remain elevated. So that's all for Fortress Minerals. I'll now pass the time on to Terence for Keppel Corp.
Thanks, Vivian, and good morning, everyone. Keppel reported first quarter 21 results, which were largely in line with our expectations. In our next slide, we provide a summary of their results. You can see the table on the left, which provides the summary of their financial first quarter 21 results. So for first quarter, revenue came in at about $1.9 billion, forming 26% of our full year 21 forecast. Net profit was also stronger year on year, with Keppel O&M's losses narrowing. So we are not able to provide the net profit number because this is a voluntary disclosure by Keppel, who has already moved to half-yearly reporting. So we don't know what the net profit is, but we know it is higher than last year. And this is driven by improved operating performances across their different business segments. And even for their weaker segment now, which is the O&M segment, we know that there's a pickup in the performances. The EBITDA improved, the losses also narrowed. But that's all we know. So we distill down to the different line items. For energy and environment, this was down on a year-on-year basis by about 50%, dragged down by Keppel O&M, but is held up by the steady performance from Keppel Infrastructure. Under urban development, this showed that this is their best performance, but this is because of the strong performance in China, Vietnam, and Singapore. Their newly launched the Reef at King's Dock, which was launched this year, is already about 80% sold. Their connectivity segment is actually flat for on a year-on-year basis. This is dragged down a little bit by M1 because of the prepaid revenue, but held up by their different segments in there. Under asset management, this was also up, boosted by stronger operating results and mark-to-market gains of their investments. As a whole, net gearing was 0.88 times as at first quarter 21 versus 0.91 times as at December 2020. Had the Keppel Bay Tower transaction been completed, this was previously announced that they are divesting Keppel Tower, the net gearing will actually be a healthy 0.81 times. So in our next slide, we summarize some of the key business updates of Keppel Group. The Keppel O&M's net order book could potentially double to 6 billion if they secure the P78 FPSO project with Petrobras. So basically they are in advanced discussions with Petrobras. No deal on the table yet, but the guide is that if they actually secure the contract, it's a $3 billion contract, then this will actually potentially double their net order book, which is definitely a positive for them. Keppel also disclosed that their logistics divestment is into phase 2 of the strategic review process. They expect a final offer could come in the third quarter of 21. The buyers are currently conducting commercial due diligence on the business. So this will be a positive also if they divest off the logistics business, because it's loss-making now, and also a laggard in their whole entire business also. One of the negative, though, is the material uncertainty increased Energy's ability to continue operating as a going concern. So earlier last week, Chris Energy actually came out with an announcement to say that they have serious doubts about operating, being able to continue operations as a going concern. This is due to the lack in expectations, in meeting the expectations of their orders in Cambodia. So for us, we foresee a potential impairment coming along. So if you look at the table on your left-hand side, you can see some of the carrying values of some of their investments, some of their the revolving credit facility to which Keppel has provided a guarantee, and some of the credit facility. I won't go through because of the time here, but in total, they have about $318.3 million that could potentially be impaired. Of course, they got some asset value, so we don't see a full impairment on this value, and they are currently under negotiation to see how much can be salvageable. But we see a potential impairment coming up in the coming quarters. Keppel also announced that they sold a commercial and residential plot in Tianjin Eco-City for 1.5 billion renminbi in March 2021. This is not yet reflected in their results because it's only just done in March 2021. But the gains we expect to be finalized by May 2021. This is actually $1.5 billion historically for Tianjin Eco-City. A sale in Tianjin Eco-City is quite big. So we expect them to realize at least about 18 to 20 million Sing dollars in gains. Yeah, so in our last slide on Keppel, our valuation on Keppel remain unchanged. and for us, when we look at Keppel, we see them as being undervalued at the current price because they are trading below their book value for financial year 21. So historically, they trade about 1 times of their FY21 book. Now they are slightly under. Based on the sum of the parts valuation, we value their O&M business at 0.6 times book value, which is a discount to their peers. The property segment is valued at 40% discount to their RNAV. Infrastructure and M1 at 12 times FY21 earnings, and the Sino-Singapore Tianjin Eco-City project at 1.5 times book value. So that gives us a fair value of about 680, and then we apply a whole discount of 10%, which gives us a fair value of $6.12. So we maintain our buy of Keppel Corp. In our next slide, we cover Keppel Infrastructure Trust as part of our Phillip on the ground, which is non-rated. So in our this slide, we summarize the first quarter 21 results. So operational cash flow for first quarter 21 rose 15.6% year-on-year, boosted by strong performance from Ixom and the maiden contribution from Philippine Coastal. So Ixom was actually acquired. You can see it's done very well. It was actually acquired about 1.5 years ago, and you can see that the on a year-on-year basis actually increased about 50%. This was boosted by healthy demand from their construction and mining and dairy segments, but it was dragged down a little bit by City Gas. City Gas saw town gas volume from commercial and industrial customers remaining weak and also below COVID-19 levels. It's improving, but it's still a bit weak. And for Philippine Coastal, you can see their maiden contribution here for first quarter 2021 because they completed the acquisition on the 29th of January 2021. So what you're looking at here is not the full year, full quarter results contribution rather yet, because there's only about 2 months of contribution here. So for second quarter, we will see the full contribution from Philippine Coastal in there. Keppel Infrastructure Trust also, the management reviewed that as part of Keppel's Vision 2030 plan to divest $3 to $5 billion of assets every year, Keppel has put up some assets for their consideration. So this is a positive for KIT. If they acquire these assets, then it will be accretive to their cash flow. But no announcement yet so far. We'll look out for it and update you guys. So that's all from me. I'll now hand over the time to Jie Hui, who will talk about Maple Logistics Trust.
Yeah, thanks, Terence. Okay, so first up, we have the full year results from MLT. Yeah, this is our Phillip on the ground, and we have no coverage on the counter. So as you can tell from the numbers in the slides, MLT's 4Q as well as full year results were positive. Their higher revenue came from the uplift from existing properties, contributions from acquisitions, as well as contributions from their completed redevelopment of the Mapletree Old Law Logistics Park in China. Portfolio occupancy improved quarter on quarter to 97.5%, and there's no refinancing risk for the year. The leases due to expire this year stands at 26.4%. But what is mentioned during the meeting and not in the slides is that 8% of the leases have been finalized from the leases in China, Singapore, and Korea. So this number is actually brought down to 18%. Now going to market outlook, overall leasing demand for warehouse space in MLT's markets are still expected to be resilient. So the occupancies within their portfolio remains high, and MLT actually prefers to leave some buffer space. Therefore, it doesn't foresee a 100% occupancy scenario. So an example the MLT provided is that Amazon actually asked for some space at one of their properties, and therefore in growing markets like Malaysia and Vietnam, it's actually more deliberate that they want their properties to be at 97% occupancy, such that there's really space for existing tenants to grow, as well as the ability to take on higher value tenants. So on that note, the portfolio is seeing positive rental reversions for all the markets that MLT has presence in. Overall, the portfolio saw a 2% uplift in saw 2% positive rental reversions. This is mainly driven by markets like Vietnam and Malaysia, where the properties are located in close proximity to KL and Ho Chi Minh, as well as Hong Kong. The vacancies in Hong Kong are low, and there is no or little supply in 2021. China's rental reversions was at 1.7%, but this is more of a mixed bag outlook because Tier 1 cities actually lack supply, while their properties in Tier 2 cities may see rent pressures from greater availability of spaces. So, and also in addition, MLT expects rent pressures from poor spec assets. Therefore, in this year, MLT will look to step up on divestments for those assets with poor specs. They believe that the assets or portfolio to be divested is not going to be large, as in the value of the assets or portfolios to be divested is not going to be large, and they are looking at a value of about 200 million. In terms of divestment gains, it's actually pretty dependent on the assets ability to be converted into other users with higher value, such as like data centers. So I think previously they quoted that they actually transacted a few properties, one in Tai Seng, one in Wai Kau, as in one called Wai Kau Chiao. So these are actually converted into data centers, and as such they actually was able to record a pretty decent, as in a pretty high divestment gain for those properties. So that said, going forward, MLT actually don't expect divestment gains to be equally as strong, but it should still be modest in their view. Now for AEIs, in the immediate term, there's one in Singapore that MLT is looking to do for plot ratio improvement. In the medium term, there's one to do in China. So there are a couple of assets, a couple of older assets in China, Tier 1, where a redevelopment can be considered, but the government allows for more redevelopments into commercial rather than logistic assets. So for these redevelopments, MLT will only look to recycle for those with no potential to grow. Now the last portion is acquisitions. Over the next 12 to 18 months, MLT will still be looking at APAC for properties, as the fastest growing regions are almost all to be found in APAC also. From the sponsor, MLT sees China, Malaysia, and Vietnam properties to continue going into the pipeline. Outside of the sponsor, MLT will be actively looking at Australia and Korea. So previously they were doing acquisitions of portfolio value, I think 200 to 400 million. Now they are looking at 600 to a billion. They believe that there is no reason why they can't continue to do acquisitions of their size now, especially since they completed the 1 billion acquisition in China, Malaysia, and Vietnam back then in December 2020. Yeah, so this is all for MLT. Now we'll move on to MNEC. Yeah, MNEC is another video on the ground, and this is based on their recent full year 20 results. We have no coverage on the counter. So starting with key highlights, the second half of their FY20's distributable income and DPU improved year on year, but on a full year basis, both are still down due to higher rental relief granted to retail tenants at Festival Walk, as well as lower average rental rates at Festival Walk as well as Gateway. So this lower average rental rates as well as higher rental relief granted helped to improve tenant retention, as MNEC actually saw an improvement in portfolio occupancy quarter on quarter. On a half-on-half basis, portfolio valuation remained largely stable, but year on year actually fell by almost 5%, largely due to the COVID-19 impact on Festival Walk, although this is partially offset by MNEC's acquisition of the Pinnacle Gangnam completed on 30th October 2020. So just a bit more on Festival Walk, which is historically the main contributor to pre-COVID MPI at about 62%. Its current occupancy is still high at almost 100%. FY20 last year's footfall and sales were still 30% and 20%. Sorry, footfall and sales were still down 30% and 20% down year on year. And the leases were renewed at a 20% negative rental reversion. Therefore, it's no surprise that the MPI generated for the property is still about 30% below pre-COVID levels. On the brighter side of things, retail sales and footfall in Festival Walk has been recovering in February on a year-on-year basis. This excludes the period where the mall was impacted by closure. So by and large, it should still be a good comparison on a year-on-year basis. Yeah. Now going forward, MNEC believes that the REIT may still continue to see lower rental reversions before seeing a recovery in rental rates. It will continue to focus on tenant retention as well as higher occupancies within the portfolio. Since April, their offices began to see a gradual recovery in terms of the occupants returning. in terms of the occupants returning to office. So especially in the case of Sandhill Plaza, where it's more of a business park rather than an office building, the property actually saw positive rental reversions of 5% for the year, as well as higher occupancy quarter on quarter. We also saw 100% of the community returning to office. On the Japan side, as Japan's COVID-19 cases still continue to rise, it's likely that the current rates now may not be able to sustain. So it's likely that this recovery of tenants coming back to office may be thwarted in the near term. Now, the last 2 points. New leasing demand came from the usual suspects like your tech, media and telecom, semicons, and biomeds. Although the gearing levels are on the higher end for the REIT, at 41%, the REIT is actually comfortable with higher gearing levels in a range of 43 to 45%. In terms of acquisitions, MNET is still keen on diversifying its income stream into markets that they are familiar with. So I think Japan and Korea helped to buffer for their underperformance of Festival Walk this year. So moving forward, MNET is looking at Japan, Seoul, and China, where there's still continued demand for offices. Yeah, so this is all from me. I'll pass my time on to Ned for KDC.
Thank you, Jie Hui, and good morning, everyone. So I'll be talking about Keppel DC's first quarter 2021 results. So starting off with the table on the left-hand side, we see that revenue actually grew by 10% year on year, and this was mainly due to contributions from Amsterdam Data Center, which was acquired on the 24th of December in 2020, as well as Kelsterpark Data Center, which was acquired on the 1st of May 2020. This quarter also saw contribution from the completion of AEIs from Dublin 2 as well as DC 1. So DC 1 is located in Singapore, and it is actually leased out to MediaCorp. So 2 floors of it's predominantly a shell and core asset. However, 2 floors were converted into fully fitted leases, and also allows Keppel DC to charge a higher rent as well as service charges for managing the fully fitted facility. Flowing right down to your DPU, we see that DPU actually was lifted by 18.1%. Yeah. Okay, so for the positives this quarter, we saw that obviously is the MPI and the DPU growth of 10% and 18.1%. This quarter also saw the completion of, or rather the practical completion, which is the TOP of IntelliCentre 3. So this asset is located in Sydney, Australia, and is located just adjacent to another asset called IntelliCentre 2. So this asset, they managed to secure a 20-year lease for this asset in the quarter, as well as extend IntelliCentre 2's lease by 20 years as well. On the negative side, we saw that gearing inched up very slightly quarter on quarter from 36.2% to 37.2%. And this was due to debt drawn for AEI payments, and valuation has not yet reflected this uplift because Keppel DC actually conducts valuation on a yearly basis. Yeah, so this valuation uplift has not yet been reflected, and that also means that gearing might be slightly overstated. Overall, we know that Keppel DC still has a very high interest coverage ratio, ICR, of about 13.1 times. And not to mention that this 37.2% gearing is way below the regulatory limit of 50%. In terms of outlook, demand-supply gap is likely to push market rents up for the Singapore market over the coming 2 years, and this coincides with leases expiring in Singapore. So the WALE for the Singapore co-location assets are actually between 1.2 years to 1.8 years. The management also sees stiffer competition for assets, compressing cap rates by about 50 to 70 basis points year on year. What this means is that assets are getting more expensive as competition for assets increase. And the management has seen deals coming in at sub 5% to 7% acquisition yields. So moving on to the next slide. We are still maintaining our accumulate on Keppel DC with an unchanged DDM-based target price of $3.20. So our target price actually includes 500 worth of, assumes 500 worth of acquisitions slated for 4Q 2021 at MPI yields of about 6%. So overall, the DPU yield for FY21 and 22, we are expecting a 3.7% and 4.2% for these respective periods. And if you look at the graphs on the top starting with the graph on the left, we see that KDC's historical yield spread presently is actually somewhere near the red line, which is about 200 basis points. So this yield spread is the yield minus the 10-year bond yield. And it's of course more attractive compared to where the yield spread was in 2019 as well as 2020, where it was pushing lower towards the lower green line. So that was slightly shy of 100 basis points. In terms of price to NAV, we see that it's actually currently now about 2.2 times price to book. It's come down slightly. I think overall this price to NAV metric, we believe that the yield spread metric is actually more representative of how Keppel DC should trade. Yeah. So just the price to NAV is just a reference. Okay, so now moving on to the next counter, which is Keppel Reit. So this is our this is our Phillip on the ground, and we have no coverage for this counter. So this is also Keppel Reit's first quarter business update. So just as a refresher, Keppel Reit is an office REIT, and they have presence in Singapore, Australia, as well as in South Korea. And in terms of AUM, Singapore forms the largest geography at 77.4%. That is of course followed by Australia at 19.2%. So in terms of the update, we saw that distributable income actually grew by 22%, and this was due to contributions from Victoria Police Centre, which achieved its TOP on 6 July 2020, as well as contributions from Pinnacle Office Park, which was acquired on the 31st of December 2020. Keppel Reit managed to achieve positive rental reversions of 10.9%, and this was attributed to the Singapore assets. So most of the leases signed in this quarter were actually for assets in Singapore, about 98% of the leases. So of course, this rental reversion, we know that there's a bit of a soft rental market, office rental market for Singapore. So this rental reversions, of course, is purely based on where the signing rents were 3 years ago. So 230,000 square feet of space, which is approximately 53% of One Raffles Quay. It was returned by UBS, and that space has now been 89% committed and with positive rental reversions. So the retention rate for this quarter was slightly lower at 44%, and the new demand was seen from banking and finance tenants, as well as manufacturing and distribution and legal. So for banking and finance, it was more from the family offices and your hedge funds, as well as some insurance, rather than your actual banking kind of tenants. Portfolio occupancy at 96.5% is relatively high, and the WALE is at 6.7 years. So in terms of expiries, for 2021, 8.1% of the leases are up for expiry, with an additional 5.3% up for rent review. And for 2022, rental expiry is about 16.4%. So that is relatively low, especially considering that the office market is still trying to stabilize and recover. In terms of leases with banks, which is where Keppel Reit actually sees most of the returning of space, downsizing, etc. So about 2 to 4% of leases are expiring with banks for both 2021 and 2022. Okay. Moving on to the right-hand side, we see that all-in interest rate actually fell relatively significantly from 2.58% to 2.01%, and 85% of Keppel Reit's debts are actually hedged on fixed rates. K Reit also did private placement for the acquisition of Keppel Bay Towers, which is slated for completion in June 2021, so it's coming soon. And this placement was actually 4.6 times subscribed. And there remains 467 million in capital distributions to be deployed, and then this can be used to shore up DPUs, and smoothen out DPUs. So just as a reminder, Keppel Reit actually did divest one of their assets. This was in Bugis at a very attractive exit yield of 2%. This was done earlier in 2018 or 19. So the observation from the management is that the banks are the ones that are downsizing. So they have given up, anywhere between 10% to 30% of the space. And there have been some non-renewals. So that means 0%, that means 100% of space has been given up. Leases signed were on standard commercial terms, about 3 years or 5-year terms. So not really short leases here. Foreign demand has not yet picked up as border restrictions are still in place. So that's all for me. I'll now hand the time over to Paul.
Thanks, Natalie. Next slide. Okay, we'll go. The one in terms of Singapore macro, there wasn't really much in terms of headline macro, but the main one, I guess, was URA released their first quarter residential data, private residential data. So in terms of the first quarter, we saw that the prices was up 3.3%. There was already a preliminary number, 2.9, but I guess this is even higher than that. Importantly, over a 12-month period, the prices were up around 6.6 or maybe 7%. And important to note that, as we mentioned before, I think the last time we had an increase in ABSD in July 18, the preceding 12 months, prices was up 9%. So we're kind of close, we were 7 and then it was 9. So and we think that prices is likely to increase further in the second quarter. I think one way to gauge, I guess, is that the inventory of unsold units of developers, I will show you a chart later, are at 2-year lows. This is below their 3-year average, and this is probably like a multiple year lows in terms of inventory. So, I mean, one way to read it is that with the lack of inventory, developers have more room or more willing to raise prices. In terms of the US, obviously we all heard about the plan by Biden to raise capital gains tax. The plan is to raise, again, this is at the very ceiling, and it's a bit complicated because it depends on your income levels, but the highest right now is 23.8 to, they're planning to raise it to 43.4. And do note, capital gains tax in their context is, in general, is anything sold more than a year, and it has to be realized before you get the gain. Before you are taxed on the gain. In terms of what is, how to read this and any way to kind of trade around it, again, this is a bit complicated because it's not even confirmed whether Congress will approve it and in what form. But if it really does go through, I guess some investors might maybe conduct year-end selling to avoid the a hefty 43% tax. You might want to take it upfront and then sell it and take on the 23%. Again, this is all speculation. I mean, this is one way, this one approach that some might take if this thing actually gets rolled out. In terms of some of the data coming up from the US is generally all positive. I mean, we can see the economy is improving and accelerating the growth levels. They have the initial unemployment claims. Basically, these are people first time filing unemployment is about, I think you read about 550, is the lowest since the pandemic, but it's still like almost double from the 2019 average. So this is important. So it shows that this is far from the Federal Reserve's requirement of maximum employment. So this data won't kind of like nudge them to kind of raise rates or tighten. The other thing is that the US, if you thought Singapore prices was hot, I think the US numbers are even, the prices are even stronger. I think in March, their medium existing home sales means like a secondary market pricing is a record 330,000 in March, and this is up 6% in 1 month. Like ours was up 3.3 over 3 months, but this is even like double the pace and only in 1 month, up 6%. So housing prices in the US are very strong and at record levels. In terms of our view, tactically, we think market might move a bit sideways. In general, very short term, because there's two risks emerging, although they're not like very severe in a way, I guess. But there's right now they're going to raise taxes to fund the fiscal stimulus, whereas in the past the fiscal stimulus wasn't tax funded; it was just deficit funded. And then of course we now have the worrying that the pandemic is now raging and is at record levels, and it might delay any reopening. Especially for us, could also delay any reopening of our international borders. These are, in terms of weeks ahead, these are some of the key events. I think you can see a lot of the FANGs are reporting their results now. Alphabet, Facebook, even Amazon reporting. This is just for your reference. In terms of events by us, we can see that under the Poems webinar, we will have Fortress, Sport for Me, Penn United, and real estate agent APEC Realty, the part of the owned by the ERA, I guess, if those who are not familiar. You can just go in and register. Some of these are not in the Poems yet, but they are definitely confirmed. Just that sometimes we need time to put them up in the Poems website. And again, sometimes you see there aren't many events because of blackout period. So once the blackout period is over, we will kind of initiate more events by the listed companies for anyone who's interested. Next slide. Okay, of course, this is the worrying chart. I think you can see the blue line is which is the daily COVID cases. These are record levels. So we've hit like 812. Refer to the right-hand side scaling, 812. This is a new high again, and the previous high was 733,000. So now we're 812. And the worrying thing is that we are rising 60% month on month. I think we all know where the cases are: India, Philippines. These are all. That's why you can see the gray line in Southeast Asia. The cases also skyrocketing, almost 300,000. Yeah, it's quite worrying. And then Japan is also undergoing a state of emergency. So the cases are skyrocketing again. Probably another third wave underway, and they're rising quite fast. Next slide. Again, as usual, we try to pinpoint some of the countries. The thing is that right now, the emerging markets, the emerging countries are at the epicenter. So you can see in blue, I mean, sadly, like India, you can see the cases are hitting like 280,000. The most recent number is almost 300,000. So continue to escalate, the blue line on the left. And also you can see Japan is also undergoing another, I'm not sure, like third wave, also hopefully not, but this is what's happening. That's why they need to lock down. The good thing is that the richer countries, I guess, in Europe, they're all, you can see the things are all trending down. So cases in Europe is turning around. So that's a positive. Next slide. Okay, in Singapore, this is up to Saturday, so we didn't take in the Sunday's number, but I think we are also getting a number of new cases, about 11 in a week compared to 8. This is the highest weekly average since January, and we got like 5 cases in one day. This is the highest also in December. But I guess for us, although the numbers are high, it does not mean, I mean, statistically at least, that it will cause us to roll back some of the phase 3, phase 2, because so all these things are still high. So these are kind of the high numbers even before phase 3. So these are like even after phase 3, all these numbers happened and they didn't roll back, and we even went to the phase 3.5, whereas in a way, the authorities relaxed in 5th April, even though the numbers were higher. So it's not something to worry about unless we kind of hit like the July numbers or May numbers, then they're a bit worrying. So even though these are the highs back in January, but the authorities, if you recall, still relaxed in April. So it's a trend to watch, but I don't think it will be enough for them to kind of roll back some of the relaxation they've done. Hopefully not. Next slide. Okay, this is just to put in chart form the residential numbers. You can see sorry, it is a bit hard to identify, but the arrow, the second last arrow from the right, that was the last rally we had from the 9.1%. You can see the steepness of it. And then right now, we're also getting another big sharp increase. So this is a bit worrying that the authority might see this and start to tighten. So we think if they do tighten, we still think that it will be TDSR rather than the ABSD in view of the weak economic conditions. The table on the right is just to show you in red line is the inventory. This is the inventory of the developers based on the current number of sales. So based on past 12 months sales, how much inventory they have which is unsold, or whether it's either completed or not completed. So you can see that the red line is 2-year low, the 2.0 there. I mean 2 years of inventory, and these are like kind of the low since 2017 levels, and this is far below their average of 3 years. So what we can, like we mentioned, this may also mean that developers have very little stock to sell, and then they've got room for them to raise prices. Next slide. Okay, we have this filler on the ground just for information. Like the reasons why we do this is, a lot may not be able to get access to all these conference call, analyst calls. So we just want to give you some of the key points that was mentioned. So for Aztech Global, as you know, they are the contract manufacturer. So the numbers was really good. I think their profit for first quarter business update was like 2,100% up. But that was because, if you recall, a year ago in January, March, China was virtually shut down. So they didn't virtually no profit. So that's why the numbers look so incredible. And of course, the other good thing is that their balance sheet after the IPO was net cash of 240 million. Some of the other points they mentioned was they got 11 new projects from new customers, and this will start to contribute in 2022. These customers didn't contribute in first quarter. Their main customer, sorry, if you go back to the first point, the IoT is 90%. So their main customer, I think, as you all know, is an Amazon product, the security camera, and that's the one that's helping to drive the earnings, the revenue. The other thing they mentioned was the order book was roughly about 500 million, and this is much like 20-30% higher than a year ago, same time. And also, if you do a rolling 12 months of the PATMI, very high chance they will be better than the 70 million. So if you just take that, they are like 12 times PE excluding cash. So I mean, the way they're growing, we can almost guess that they're hitting probably 80, even 90 million profit is possible. The other thing is just Avarga. Avarga did a briefing for the analysts. Again, all this we don't cover, but they just did a briefing of their FY20 results. For those who don't know, I think Avarga is owned by, those who know Malaysia, they're owned by Tung Kui On, the owner of the Age magazine. So the earnings though did well, they're up 70%. Most of their earnings, 80% comes from their stake in this company in Canada called Taiga Building Products, which is basically a distributor of building materials. They also interestingly own a power plant in Myanmar, and also they have a corrugated paper mill. For those who don't know, corrugated is, I guess if you buy a lot of e-commerce products, everything is in corrugated boxes. So they produce those paper. So why they did well, one of the key reasons is the surge in lumber price. So I think lumber price used to be 300. I'm just looking at the chart, 300, I think jumped to 900. So that's why they did well, and in a way it's like a one-off gain in the beginning because you have cheaper inventory. But the other part of it is that they can still earn 10 to 12% margins on top of the higher prices. So no, maybe it used to be 10 to 12% on $300. Then now it's gone to 900, you can still earn the 10 to 12%. So obviously your earnings will do well. And even when I look at the chart, year to date lumber price is up from 900 in December to right now about 1,003. So you can safely assume FY21 should be another good year for them, because the results here is up to FY20, December 20. So we don't have the FY21, but with the way lumber prices are rising, they should be another kind of good year for them again. The other one is paper mill. It should do well, because the amount of, it's a way to pay e-commerce corrugated paper boxes. But the one thing they mentioned is that there are many Chinese plants being set up in Malaysia. So that could be competition because corrugated paper, the scrap paper is banned in China. So a lot of them set up plants in Malaysia so that they can get the basic raw material and then export it back to China. In terms of the Myanmar power plant, of course, all of us are curious what's happening, but they said that they're still receiving regular payments in US dollar from the government. I guess they're more worried of whether they got enough spare parts to run. I think they're a bit worried of the supply chain disruption, but they got enough spare parts to year end. That's what they mentioned. Again, all this is just for those who could not attend, but we just want to share what was, I guess, discussed during the meeting. Next slide. This is my last slide. Okay, this will be all our corporate results. Actually, if you look at our morning note, we actually will in the calendar, we actually will show some of the results that's coming out now. But anyway, these are all the results coming out. In yellow are those covered by us, Phillip Securities Research. And I guess some of the big ones will be, of course, DBS will be on Friday. Then we got Yang Zhejiang and Wilma too on Thursday, the results after market. So these are some of the big ones coming out, and the rest are all covered by us. Okay, that's my last slide. Thanks everyone for listening in. We can take questions if there are any. Thank you. Yeah, I think we can do the technical. I think there's a lot of technical questions. I think Viren, you probably can go ahead first.
Okay, so anybody can hear me? If yes, just give me a 1. or something while I prepare my screen for the next thing. Okay, one more. Yeah, okay, so next one is, okay, so in that case, I will just go into the Q&A. So you can see my screen, right, that I'm in on my chart right now. So yeah. Okay, so I'll just go on to the first one because I'm hosting, I host the webinar earlier on. Okay, so yeah, sorry, I forgot to start on video. Okay, sorry. Sorry, guys. Yeah. Okay, so starting it first. Okay, so if I'm looking at the first question. It's about Mapletree Industrial Trust, and then I think I saw some of the questions as run through. I will do the Mapletree Logistic, and then I'll follow by offenders. All right, so that could save time and then not repeat the question. So given a fact, I think Mapletree Industrial Trust, like I've been mentioned a lot of weeks. A lot of webinars. So Mapletree Industrial Trust actually has a slight correction upon reaching the $2.80 to $2.84 resistance. However, I think it's well supported at $2.76 for now. All right, so in the end, I think price is returning to attempt to break $2.80 to $2.84 resistance zone. So hence, if it successfully breaks it, the next target, $2.96 and $3 will likely be the target. I foresee, which I think it will break the resistance zone. I think prices is going to reach the target of $2.96 to $3. I think in the next 2 weeks. All right. Given I mean the 3 days later is the results briefing. All right. So yeah. Okay. So I go on to Maple Lock. Okay, give me a moment. Okay, so Mapletree Logistic Trust performed better after it rebound from the support zone at 38.2 Fibonacci level. And then right now it has already break the ultimate, this, if you invert it, it will be like around 78.6% region of the inversion. So we are targeting the next resistance zone. So $2.07 to $2.11 will still likely be my immediate target for now, especially it has a V-shaped recovery. And then there's like, if you look closely, there is some sort of like multiple resistance testing within the zone itself between $1.98 to $2 psychological upper bound resistance level. All right. Okay, then next one, I think Ascenders did well today. Ascenders actually rebounded and then it closed above. All right, but we are still very wary because this is not a very strong closure above the upside. All right, so but nonetheless, I think in the longer term, we are still looking for upside. First, we are looking at the breakout of the falling wedge. Next, I think we do still have a standing triangle intact. Never mind if it breaks off the resistance, breaks off, and then it correct and come down lower. But I think the $2.90 to $2.93 support levels over here, support zone is likely to be a very good chance to test for rebound. All right, so that's all. So I'll move on to the SunPower. Okay, so SunPower, can see that there is like a diamond, a head, like a potential head and shoulder formation going on, forming. However, I think if it's likely to break strongly up above 0.90, I think we are seeing a next target of 1.03 in the next future. You can see that this is a true wave down and then 1, 2, and then a true wave up. So even if it target at 1.03, I think it's still, unless it close above 1.03 in the longer time frame, in the longer time period. Otherwise, I think that this one will be just another corrective flat, which will result in in a further fall to maybe perhaps retest support zone 2 or go lower to support zone 3. We shall see much in the future, but short term wise, I think we are seeing further upside for SunPower. All right, but if you ask me for my true opinion, I think I will just stay hold on for SunPower because I think the technical is showing some signs of like weak, a bit slightly tilted to weaker momentum of the upside rally. All right. So Yang Zhejiang has already like breaks off my target resistance. So like I mentioned, I think 1.49 will be my next target resistance to 1.53 will be my next target resistance zone. So let me just plot it out. Okay, so yeah, this is my target price actually. Okay, next target price. However, I think that will there be a correction? I think there might be before it goes up. So either it's going to head up low higher before rebound and then just test it on the upside or whatsoever. We need more details. Sorry, Mr. Chiam, I don't know what is SCI. So if you have stock code, just let me know. So pardon me. All right, thank you. Okay, Chris, ISDN and Rex International. I think Rex International, I'm more tilted bullish. Okay, so ISDN, I think I did I think 3 webinars ago. I'm foreseeing some side of like sub double tree wave up on the upside. Target here will be like 0.695 to 0.705 before a correction to the support zone before a rally up. So I think that we are still going to see some ranging period going ahead. But nonetheless, I think ISDN will see some more bullish upside in the coming weeks. Okay, all right. So okay, so Rex International actually short of 5 cents off or 10 cents off my target price from the report in March, and then it came into a correction. So nonetheless, I think we have already tested almost break the resistance zone over here. So you can see I like to plot this as a congregation of resistance. So there's some pullback, but however, I think it's kind of like well supported over here. But however, I think I foresee some more correction. Perhaps back to the worst case scenario is back to 1.54 to 1.58 before rebound. Okay, means that there will be a false breakout of the pattern. I think otherwise, I think I will just stay put at 1.68 to 1.65 support level, which is this level. If you were to ask me, we like 1.65 region going forward. Okay. Right. So this Rex. So I'm done. Avarga. Avarga, I don't have a stock code. Okay, U09. Avarga, I think it do have some sort of like it broke out this ascending triangle recently, but I think that right now we are currently ranging. It looks like we have a head and shoulder pattern with the sloping neckline resistance. So for this, I think Avarga, not much data I can say, much of the movement ahead. So I'm going to stay neutral on Avarga. Thank you. Okay, so the next one is AEM. AEM. Okay, I'm going to do AEM. I think AEM. Looking for a best case scenario is to look for range bound. So the resistance zone, immediate resistance have been tested, sell down. Foresee some sort of like upside initial in the end. But if you're going to divulge it further, I think it will be this and then like this. So this will be the likely outcome, and especially I think in my breaks and then we test the support zone lower and then goes up. So There's the pattern that I'm looking for, and then there's a flag that I'm looking for as well. So I'm going to see how AEM is working out. So Sheng Siong wise, Sheng Siong, I think there's an inverted head and shoulder, but I think the upside is going to break, but not very strong. Perhaps it will go and test 1.61 maximum. Still looking at the target at 1.32 to 1.36 region for rebound. All right, or perhaps maybe a bit of 1.38 to rebound. So although Sheng Siong has been doing well, I think fundamentally, but we are just in need of a correction right now. You can look here, we are still on the corrective downside. So perhaps we'll be looking here at further downside as well, especially after it has already confirmed the head and shoulder formation. All right. So Singtel, I think limited growth. Okay, so we are still looking at the this come down resistance. This is a support term resistance zone. Okay. Yeah, so this support term resistance zone is between 2.49 to 2.52. So hence, I think any upside will just be consolidative for now. All right. So like I think this movement has really been completed. So actually this one. So but the rebound over here at the support zone between 2.49 to 2.52 is not that strong. So hence I will just stay put for now for Singtel. So in fact, the bearish candle today, it might just continue to break lower for that. All right. So venture, I think venture, you can look at my report. My target price remain unchanged. Still looking for the upside once again. All right. So yeah. So you can look at my report. I'll post a link to our. You can go to stocksbnb.com under technical pulse. You can look for venture, type in venture, and can search it. But just an update. I think the upside is strong. So. It has already broke the immediate resistance at $20.48, and then the next target will be $20.82. Once this zone are broken, we can see that the upside will be roaring up ahead for venture. All right. EY. Okay, I think it's BYD. BYD. I'm still bearish on BYD. Okay. So hence, I think the bearish flag is still ongoing, and then I foresee some more downside for it, and then especially this rounding top, and then this like head and shoulder formation going on. All right. Okay. SMIC is the Hong Kong. SMIC downside ranging market. I foresee some upside will be limited between $31.85, but I'm tilting to the downside of a rebound near $17.75. All right. Okay, so next one is 1288. Okay, so Agricultural Bank of China, I did a report this morning. Unfortunately, I think that this Dragonfly doji didn't really push the price higher. In fact, it has a sell down. So once again, I think it might travel to my stop loss below $3, and then $2.97 and $3. You can look out for a. Let me see this. Okay, this zone. You can look out for it between $2.97 to $3. This one will be the one that maybe there will be a rebound thereafter. All right. Okay. Thank you. And then 1658. I think it's PSDC. So PSVC also have a sell down, but nonetheless, I think if you look at the Fibonacci retracement level, we're looking at 0.618 to this level. So this support, so it's between 4.96 to $4.71 I'll be looking for. But doesn't mean that if this price close above with a strong bullish, above the 50% Fibonacci retracement, it's not a go. But what I'm saying is I prefer to hold on to this, wait for this level to rebound. But if you happen to see this bullish closer by end of the day, which is around $4, I don't know what $4. 4:30 p.m. Then I think next day, I think it will continue a bullish upside. All right, especially this has been completed. If you measure this, we have actually completed near 200%, 1:1 of the ratio of the diamond pattern above. All right, okay, thank you. SIA, UMS, and Genting, I don't know if you are looking for a technicals or just waiting for Paul. I think leave it to Paul. Yeah. Okay, so I'll do a last few. I'll look at it. I'll do UOB venture, UOB, and then Genting, and then I'll pass my time to my colleague. Okay, so I'll go to UOB first. All right, and then you can look at UOB. I think upside testing, but I think target price of higher price. You look at a weekly chart. We are looking at this level of resistance as a next zone. So short-term wise, $27 and $28.01, difference of $1 will be expected. All right, based on the weekly chart. Okay, and then the daily chart, you can see that continuation upside. Not strong, look corrective, but nonetheless, any correction will be well supported, maximum at $25.30 before attempting to test higher. All right, so I'll go for city development. C09. Okay, so city development, it trend lower based on what last week I shared. I think he has hit my stop loss. Given the weak bullish momentum, this look like a bullish Hikake. But I think there's an snare, so it might be a failed bullish Hikake going forward. Will rebound $7.68 going forward. All right. And then last one, I will answer Genting before I pass on my time to colleague. Okay, so Genting stopped out already, breaks off the flat. So I foresee some upside will definitely be a correction of the downside. So we are looking for further downside to 0.850 region. All right. So with that, I temporarily end off my time for the technical sharing. I'll pass on my time to my colleague who will do a sharing for the rest of the question. Thank you.
Yeah, I'll just quickly run through some Aztech global questions. We don't cover it, but I'll just try to help out. And there's a question on Keppel Corp. Okay, anyway, just on given the track record of Aztech in the past listing, is it still advisable to invest in Aztech Global? I can't say if it's still advisable, but do note that I know there's a lot of flag. Again, we don't really know them well, but when we look at the data, I mean, there's a lot of flag about them privatizing, but no, they privatized in December 16 when they were making losses. And the big customer they had, which I think gave them almost 200 million in revenue a year ago, I think this year should be even more, only came to fruition in February 2018 when it was acquired by Amazon. So it was almost a year after privatizing, then only they got this super, I wouldn't say lucky, but at least they got this incredibly, this major customer for them, which is almost like 70-80% of the business. So if you look at the timeline, unless they knew this customer would grow like 10x, or I think it's 10x, or from 20 million to 200 million, unless they knew, then maybe they privatize it. But I seriously doubt Amazon will share with them that what they're going to do. Yeah, so that's my own thoughts. Again, I can't verify anything, but the timeline from them, from privatization in December 16 to the new major customer in February 2018 is a bit long, I think, for them to even kind of like have a heads up whether this thing can be so big. Yeah, that's my own thoughts. Yeah. The other thing is any lockup period. Yeah, there is a lockup period of 6 months from listing date. What's their business capex? I'm not sure what's the capex. I don't cover, but and what's the strategy? Sorry, the question is what's their business capex forward and strategy forward since they're doing well. I think their strategy now is try to reduce reliance on this major customer. But note that this major customer, from Amazon, I believe, they're only selling in the US. They haven't even gone overseas yet. So there is still some room. There's still areas to grow this particular product, which is wireless security. And again, that's a reminder. The reason why this product does well is because it's Amazon, right? But and also number two, the strength of this product is the power supply, because they are very good in designing power supply chips. Now, which means that you just have to use normal battery. You don't have to go on charging it and anything. Okay, I hope that helps. I mean, again, we don't cover, but this is just our own views. Amidst the next one, amidst the COVID fourth wave, clearly breakout on gloves. What's your view on TA? And there's another one. With the COVID research, what's your view of gloves and medical stocks in the near future? I think the pandemic will keep on raging the way the numbers continue. It's rising 50-60% month on month. I think this could occur. The jump could continue at least another 1 to 2 months. I mean, based on the past trends, right? Usually when you on this major kind of surge, right, it seldom tapers down. I think you could see continued surge in cases. Again, this is just a guess, but just looking at the past times, it will drop maybe 50, 60, then go back to 40, 30, but it's still growing month on month. So that's the worrying thing. That means it continues to accelerate at the numbers. So this could continue. Again, then this of course will be a way to trade on the glove and medical stocks. I guess that's the best I can do. This is my last one before we pass on to the rest. What do you think about COVID resurgence and the new breathalyzer product substitute on QMM's just a refresh? I think QM they're selling the PCR kit and they're also doing the testing. So they got two cuts in the revenue. Of course, the cases now, I think the government might accelerate even more testing. I think the breathalyzer is I think speaking to others, I think the breathalyzer is actually quite a valid product because of the ability to, I think their accuracy is high 90s. But again, you still have to see if you can hit the kind of volumes the government want. I mean, the government even mentioned before they want a 40,000 per day ton of tests. So I'm not sure even if it works, whether they can hit the kind of numbers. For us, we're only assuming QM, I think about 1,000 a day. That's only our assumption compared to what's happening right now. I think maybe about the government's testing maybe 20,000. Again, they don't give us the numbers, but based on the last media, about doing about 20,000. So even if the breathalyzer comes, there's still more than enough. The market is big enough to cater for everyone. Yeah. I hope that helps. Yeah, we will try and get Q&A on for a webinar, then you can ask them directly. Okay, let's move on to others. Yeah, I forgot to turn on my camera. Okay. Yeah, whoever's answering can turn on the camera. I forgot. Yeah. Terence, can you go ahead with the Keppel Corp?
Hello. So I have one question on Keppel. Sorry, let me just get to the question. Why do you think there will not be any dividend in financial year 2022, despite record profit and record cash in your forecast? So I looked at the report. It's actually my mistake. I left out the dividend. The dividend should be 25 cents for full year 2022. I'll put out the amendment later. But yeah, thanks for the question. That's all. Thank you.
Yeah, okay. Anyway, I can't start my video. The host has stopped it. Okay, any comments on the venture and Riverstone? I think for me, I mean, for when you're dealing with venture, there's virtually no visibility. I mean, they don't tell you the customer. They don't. There's not much to say. The only thing is that I don't think the growth this year will be that strong. My own view. I mean, based on the last meeting. they are pursuing, they are trying to, the big growth maybe could be next year or maybe second half of this year or later part, because they are also trying to pursue EV cars. That's one area that they're targeting, and which is rightly so. I mean, they're so huge, right? When venture, they need to target a big segment. So EV cars is one area that they are targeting. They didn't say which parts, I mean, battery or even, of course, we all asked that they won't tell you anything, but that could be one growth driver. I think venture is still fine for me, just that I'm not sure the next 1-2 quarters, the earnings may not be so strong. This quarter, you will see better because last quarter, there was a shutdown. So you could see, but for the full year, we are just looking for maybe 5-10% growth. So it won't grow as strong as the other electronic companies. But I think the following year, maybe because they're doing a lot of life science products, like genomics testing, and all this takes time. The customer not going to ramp tomorrow, so it will take time for the customer to ramp. But for a medium term, they're still a great company. Just that very near term, I'm not sure the earnings will be that strong. First quarter will be good because of the prior quarter was so bad, right? Because everything was shut down. For Riverstone, my preference is still UG. I mean, if I have to play, because UG is more skewed towards the emerging markets. I think their big customers are in Brazil, China, and these are like we mentioned, emerging countries are where the bulk of the cases are coming. So we're not sure if the US cases continue to taper down with vaccination, then demand from US will kind of taper off. But for Riverstone, the good thing is that they do a lot of electronics, so that will also be helpful. Yeah, I think both will do well. I think both have their niches, but I guess maybe for Riverstone, they have a bit more into exposure to US medical. And again, if you're splitting hairs here, then maybe demand from US medical would be less if you want to play on COVID, because the cases that are coming on. Yeah, I think that this is my own view. Sure, the rest are all TA questions. I'm not sure if you already answered, Avarga. If you have done, I think we can just end it. What's your view on SIA, UMS, and Genting? Again, some of this, sorry, we don't really cover, but you know, like we highlighted before, the SIA market cap is like higher than COVID, and you know they need to raise another round of funding, which is very obvious if you look at the latest announcement. So I'm a bit more negative on that. UMS, I'm still we don't cover, but I guess from my own view, it's still positive on it, right? Because their customers are all doing very well. All the like TSMC and Intel, all their no TSMC. I mean, Intel is building 2 new foundries. You know, each foundry is about 5 billion, and they need all these and you know, UMS is supplying to Applied Materials, so and Applied Materials is the leader. Yeah. So for all this front end equipment, so my own view is UMS will still do well. I won't be surprised if they hit record earnings. For Genting, I'm a bit more cautious. I mean, with the border closed, what can you do? Yeah, and always remember that Genting, the gaming industry is a matured industry. I think I didn't even say it's Lim Kok Teh himself said it. Yeah, I think in the AGM he did say this is a matured industry. Because most people are shifting to other online gaming and so forth. Gambling, I mean gaming or gambling. Okay, I hope that helps. Again, we don't cover some. Just giving you our own basic views. Can anyone discuss CapitaLand if there's anything?
I'll take the question on CapitaLand. So I don't really know what. Sorry for the thunder. I don't really know exactly what is it, which area you would like to talk about. But just overall, on the demerger deal, I think we have mentioned that we like the deal, and also we think that it will help in unlocking you know, helping investors actually exit the developer business at 0.95 times NAV, which in comparison to how CapitaLand has been trading in the past, it was always closer to, you know, discount of like it was always closing trading at a like around 70 to 80% discount to book value. Yeah. So apart from that, I think also the new listed entity, which will be CLIM, CLIM, will be able to trade more like how real estate investment managers trade, which is usually at a premium to, or rather above anywhere between 1.5 times to 2.5 times of price to earnings. Additionally, I think there was an article that came out. I think it was something along the lines of MAS and SGX need to scrutinize the latest restructuring plan of CapitaLand's. I think not to stir or not to alarm anyone, but I think this is I think the article did mention certain items, certain points, such as, for example, that the real estate landscape has sort of changed, and certain subsectors are facing some headwinds, such as your office subsector. The headwinds are from, of course, downsizing and flexible or remote hybrid work arrangements, and also, of course, retail is facing some competition from e-commerce vying for the same share of the pie. Yeah, and so I think the article came out saying that it seems like CapitaLand, or rather Temasek, is allowing CapitaLand to ring fence their so-called more troubled assets like your retail and office assets, while privatizing the profitable development business. Yeah, and I think the article also called for more, that probably the regulators need to pay a closer attention in the interest of minority shareholders. So I think while that view also does has its own merits, I think that overall we are still of the view that doing this deal will actually benefit the unit holders, in a sense where you are immediately realizing the value from the development book, which usually would take 3 to 5 years kind of realization for you for the value to be unlocked, versus right now exiting at close to almost 0.95 times price to book. And while there might be a potential re-rating of the REITs and the private funds listed under CLIM. So I think so that is our view. Okay, so I think I talked about CapitaLand. I'm not sure if you have any follow-up questions for CapitaLand. Okay. There's another question here that I see. It's on ESR Reit, if I can find it right now. Okay. So for ESR Reit, I think the question was something along the lines of why is it lagging? What is the fundamental view of ESR Reit? It has been a laggard. So for ESR Reit, we don't cover, but we understand that they actually released 4Q earnings update just last week. So I think just briefly touching on the performance or the update, I think they reported their occupancy is sort of not very ideal. It's currently at 95.8%. Of course, the REIT did mention that it's above the average occupancy of Singapore industrial assets. Nonetheless, I think the way the occupancy is lands is sort of under, below where their peers are occupancy are at. Yeah. So apart from that, I think they also recognized 5% negative rental reversions to the tune of 5%, and they also explained that was largely due to their some of the reversions from their business park assets. Okay, I think I just want to touch on also that there has been an increase in the FY20 DPU, the DPU and it was actually improved quarter on quarter, and that was largely due to the absence of rental reliefs granted, as well as some cost savings from interest rates, lower interest rates. I think also overall, there's also speculation that one of the reasons why ESR is sort of facing a little bit of headwinds, or the share price is facing a little bit of headwinds, is also due to the failed merger between Sabana and ESR, but I'm not sure whether that has much weighing on this share price. Yeah. Okay. So I think that's about all I can add color for ESR. There's another question here for me, I believe. The question is regarding Keppel Pacific Oak REIT. So no, we do not. Can you comment on Keppel Pacific Oak REIT? Just 1 second to pull out my notes. Okay, so of course we don't cover Keppel Pacific Oak, but we did listen in on the call that happened last week. Sorry, give me a second. Okay. Okay, so for Keppel Pacific Oak, I think for Keppel Pacific Oak, the assets are located they hold like class B kind of assets, are those lower, not really your office buildings where you think of skyscrapers, but more of like below 20-story kind of assets. And I think their focus is on locating in states where there are low or zero income taxes, so that they believe that will actually attract the flow of or the migration of companies in the long term. Yeah, in terms of their portfolio, I think they have actually secured several. They have experienced occupancy uplift. And some of the assets in Seattle, the Bellevue, Richmond area, they have actually sort of outperformed some of the real estate companies and expectations. So they managed to secure positive rental reversions despite the property. I mean, the real estate. These real estate agencies' view of weak and soft and leasing, which will lead to negative rental reversions. I think some of the assets which are located, some of the assets are also located in the Austin, Texas area, and I think those assets they actually form 5% of their portfolio, and they are benefiting from the relocation of Digital Realty to Texas, as well as Tesla to Texas, or just outside Austin. So I think there's a bit of there's a little bit of potential benefits from the movement of these larger players. Yeah. Okay. Yeah, and as for Keppel Pacific Oak, I think one point where they are trying to differentiate themselves amongst other players is that they have also done a bit of spec suites, or rather speculative building. So speculative fitting out of their assets. So this means that they actually start to fit out the space that has not yet been leased or committed, just so that any tenant they can tour any potential tenants through these spaces to let them have an idea of how the space could look like, and also it provides an opportunity or an option for tenants who are actually looking for already fitted out space. Yeah, and I think they've been doing this in a few of their assets, and they intend to do it for even more floors within the assets, so that actually might actually speed up the leasing process for some of their assets. So I think that's about it for Keppel Pacific Oak.
I think there's nothing else. I think we can end it here. This mainly for Singapore stocks. I think if you want Hong Kong stocks, I think we can proceed towards the 1 p.m. 1 p.m. meeting. Yeah, there are some questions also on Wilmar. We'll try and give you more because they were having a briefing on Friday, so we will just share with you what they said, what's happening on Wilmar. I'm not sure I take this, Natalie. What's the escort read? Yeah.
The question here is, what is the challenge for Escort REIT? It does not seem to benefit from the normalization in China. So for Escort, actually, this is that's not true, because for Escort, of course, China, as you know, is actually a relatively large domestic market. So that would mean that if there were to be any travel, especially with the border restrictions still in place, there actually is more room for the domestic travel to pick up and sort of partially offset the absence of international travel. And not to mention, I think some of the assets in China, they actually have a relatively longer average length of stay. Yeah, and so they maintained a relatively higher occupancy even throughout the COVID period. Yeah. So in terms of benefiting from the normalization, I would say that we do actually expect that China, along with some of the other China, along with some of the other markets with larger domestic tourism catchment, such as your UK, Australia, these are the geographies that will actually pick up first. Yeah. I don't know if this question has been taken. Someone asked about what's the difference between accumulate and buy calls. So just briefly, for at the end of each of our reports, we actually have this rating table where we talk about the difference in our calls. So for Phillip Securities Research, we actually have 5 different investment calls or call to actions. They are sell, reduce, neutral, accumulate, and then buy. So it just as a general or a guide, right? We look at it as the total returns that are expected. So for a buy call, we actually expect total returns of greater than 20%. For accumulate, it's somewhere between 5% to 15%. Yeah. And then neutral, of course, would be like -5 to 5%, and then so on and so forth. So I think it also just it doesn't strictly have to follow or fall within these buckets of total returns, but just more or less as a guide. And also, of course, it conveys our conviction with respect to the particular counter under discussion. Okay. Actually, I see another question here for Fraser Centrepoint Trust, so I'll just take that. Any comments on why FCT price is not moving and what is the expected dividends? So for Fraser Centrepoint Trust, we are actually expecting dividends of about dividend yield of about, sorry if I can find it right now, about 5%. Yeah, around the 5% level. And of course, I think that FCT has sort of been, yeah, I agree with you that yes, the share price for FCT has not been very effervescent, for lack of a better word. So, and I think partly that has to do with the more rotation into cyclicals, especially at this part of the economic recovery. So I think overall, we still have no change in outlook. We still believe that Fraser Centrepoint Trust, being a suburban centric retail portfolio, they actually will be more resilient against the central malls. Additionally, of course, if you look at the data that's coming out of the market, you see that the central rents have actually dipped quite significantly, anywhere between 8% to 10%. And even some of the reversions that are coming out have reached to negative 22%, double-digit kind of levels. But the market rents for the suburban kind of assets, right, are more or less holding steady. Yeah. So I think overall we still are of the opinion that Fraser Centrepoint Trust is a good counter for stable recurring dividends. Yeah. So that's about it for Fraser Centrepoint Trust. Okay, so I think we can bring today's session to a close. We're going to thank every one of you for joining us this afternoon, and have a good week ahead. Thank you so much.
the recording of the webinar is in YouTube. You can go to our PhillipCapital website, and then we do a recording of what we mentioned and even a Q&A. I mean, there was a question there. Okay, so thank you everyone. You can just go to YouTube channel. I think type PhillipCapital. Yeah. Thank you everybody for your participation. Yeah, we'll hope to see you again next week. Thank you, and do attend our webinars. Just go to the Powell's website then you can just register for the listed company webinars. For those webinars, there are no recordings because a lot of the listed companies don't want all these recordings. Okay, thank you everybody.